evolution in today as it evolves and grows into the industry we all know and work within and work around. And so welcome to you all. I really want to start with a really big thanks and shout out to our industry partners who have been integral to supporting this research and helping us to deliver it again this year, and many who have been partners with us for a very long time. So a big thanks to Australian Ethical, to BT, to AXA Investment Managers, to T. Rowe Price, and this year especially to our research partner in EY. It's been great to work with EY on the delivery of this year's research. We're going to hear from the report's primary author, our manager of research at RIAA, who will take you through the findings of that report. You'll then get some insights from EY themselves through Emma Hurd, giving a bit of a feedback from their perspective. Then we'll go into a panel discussion to unpack the data and really bring it to life as to how that's playing out in the market in real time. We would invite Q&A and interaction. Please use your Q&A function in the Zoom panel and the chat function as well to put forward your questions, and we'll aim to answer those as we get into the panel discussion later in this morning's session. So I now have the pleasure of inviting our RIAA's Manager of Research to give us the overview of the findings of this year's report. So Dr. Zsuzsa Benhalmi-Zakar has an extensive track record working in research over the last 10 years in academia, and fortunately in the last 2 or so years in-house with RIAA. We're really fortunate to have Zsuzsa on our staff. She has a PhD in sustainable finance and brings extensive knowledge and work in this field to our research program and our Leads Up RIAA's research program. So I'm going to welcome now Zsuzsa to take us through the findings of this year's Responsible Investment Benchmark Report. Zsuzsa, welcome.
Thank you, Simon. Thanks for the lovely introduction, and welcome everyone. I'm so pleased to be able to share with you our findings from this year. And let's kick off. A special thank you first to all of our survey respondents who took the time and the effort to respond to our survey and provide us with a lot more detail about the responsible investment market. So it's always a growing number, and we hope that you will continue to fill out the survey, and more of you will have the chance to do so over the next few years. So this presentation is going to be a condensed version of the report. The report's available online on the RIAA website, and we have an executive summary separately for those that just want a quick glance, and then the full report. The report can be downloaded and viewed by anyone, so you don't have to be a RIAA member. It's open to the public, and it's a great resource if you want to know what really went on in the market in 2021. So I'll present some of the key findings. The first, one of the first sections in the report is our international and domestic context section. We have a big table in the report that has all of the major events that have been happening around responsible investment in ESG. This is just a snapshot to give you an idea of there's just been a really, really busy year of last 12 months. There's been so much going on all fronts, particularly climate change. You'll see that in the presentation today, that's a recurring theme. Also other reforms around your future, your super. We had the proxy advisor regulation, which was overturned in Australia. We've got ASIC commencing some work on greenwashing. And of course, we've got the ASFI sort of rebranding itself into an institute, and work heads up with the institute as well. In terms of global developments, if you followed our policy program, you'll know that we have the International Sustainability Standards Board working on frameworks on ESG reporting. We have green taxonomy work in a bunch of different jurisdictions. We've got the task force on nature-related financial disclosures and other legal sort of efforts. So we itemize all of those in a table. We've got a separate table for international developments and separate for Australian developments. Next up is a slide that shows you the definitions, methodology, and calculations of our study. So there's always a lot of questions about how do we arrive at these numbers. So I just wanted to spend a little bit of time on explaining that. So the biggest block here is the yellow, and the yellow covers the total managed funds, which is a number that we derive from the Australian Bureau of Statistics for the last few years. We've been doing that as that's probably the most comprehensive number that captures our total managed funds market. Within that, we've got the blue section, which is what we call the research universe, assets under management. So AUM stands for assets under management. This is the assets under management of the research universe, so all of the organizations that were included in the study this year. Now, this number is 140 this year. The way we arrive at this number is that we collect all of the organizations, or the investment managers and asset owners as well, trust funds, banks, etc., that are members of RIAA. We then add to that additionally signatories of PRI from our region, members of IGCC, for instance, and we take these organizations as those that demonstrate that responsible investment is important. It's part of their strategy. So then we take this number and then we decide whether they're represent Australia or New Zealand, because we have a separate report for New Zealand. So there's that bifurcation of the data there. And then this year we made special effort to include impact investors, because it was an area that we really wanted to improve in our reporting. So we end up with 260, 70 organizations like that. And then we then look at which ones actually we can find information on, so that are accessible. So at the end of the day, that's where we arrived at 140. So we sent out the survey to 140 organizations in Australia. We had 56 fill out the survey, and the rest 84 we did desktop research on. We then assessed all of the 140 organizations on our responsible investment scorecard, and those that are leaders contribute to the green part of the graph, which is the responsible investment AUM. This year we have 74 leaders, and we also only count the proportion that they nominate as responsibly invested. So if it's not their entire AUM, but a certain percentage or an amount, if they filled out the survey, then that's all we count. So we're trying to not overstate really the responsible investment AUM there. Next up is another big number, big figure every year. This year, we're going to include the last 3-year trend in the report. And what we see is, again, an increase in responsible investment AUM to over $1.5 trillion in Australia. I really wanted to include the last 3 years because you can see that the total market change is impacted probably by COVID-19 pandemic. As look at those total numbers, those blue numbers, and then you can also look at the responsible investment AUM. So we see market growth significantly from 2020 to 2021 based on the ABS numbers. We also see an increase in responsible investment AUM. What is really striking, what has been the trend for the last couple of years, is this increase of 3 percentage points in responsible investment AUM, and basically at the expense of the remainder of the market. So the remainder of the market is sort of shrinking, and the responsible investment AUM is growing. Next up is the slide on performance of responsible investment and RIAA certified products. So this slide's a bit busier, so I'll go through a couple of things, a few things that I'd like to point out here. First of all is, look, we only report on performance in 3 categories, and that is the managed growth category, or the multi-sector growth category, the international equity category, and the domestic equity category. And that is because most of the responsible investment products fall into these 3 categories. So this is where we have the most confidence. There are, of course, other asset classes, but we are unable to report on the performance of those. So just bear that in mind. The second thing to note here is the difference between 2020 and 2021 figures. Again, we just had such an odd year in 2020, and that oddness, I guess, rolls on to 2021 as well. Again, the impact, we believe, of the COVID-19 pandemic on the financial market can be seen here. The little blue turquoise kind of arrows point to the Morningstar category benchmarks, as well as the ASX 300 index, which is what we benchmark against. So finally, the last thing the second last thing I wanted to point out is that this year we're reporting on certified products, RIAA certified product performance as well. We didn't do that last year, so you'll see the blanks in 2020, but we have such a volume of RIAA certified products that we're into the hundreds now, so we're able to come up with some meaningful averages on performance there. So lastly, then the colors. So the green colors indicate overperformance compared to the benchmark. The yellow indicates sort of on par performance plus minus 1% compared to the benchmark. And the gray is the underperformance of more than 1%. So the general trends are, and we were also surprised to find is that the responsible investment products perform really, really well. The responsible investment products, which also include certified products, also perform really well compared to the benchmarks. So we see that trend particularly amplified over long term, so at the 10 and 5 year horizons. The 1 and 3 year horizons are a little bit more, I guess, volatile as a result of what's happening on a yearly basis in the market. So there's lots there to unpack, and I'm happy to answer questions. I can see one pop up in the chat, so feel free to ask me any questions in the chat as well. Okay, so moving on to a bit more detail around the responsible investment approaches. This is another figure that we show each year. We're listing here the responsible investment approaches, the 7 approaches that the Global Sustainable Investment Alliance, or the GSIA, report on as well. That's just what we traditionally use. So we ask our survey respondents to nominate which of these approaches is used in their organizations. And we see that ESG integration is at the top at $752 billion that is under ESG integration or managed with ESG integration principles. Then we have corporate engagement that should be in the second spot. That's a huge increase, and I'll talk about it a little bit more. So it's phenomenal, the amount of change that we see in this area. Then negative screening remains popular and a key component of responsible investment. Then sustainability themed investing was another growth in 2021. I'm very happy with that result, and really excited to see that. And then norms-based screening is where we actually see those numbers drop. Norms-based screening is not very popular in Australia. Best-in-class positive screening comes next, and impact investing is the smallest category. So moving on, what are we seeing in ESG integration? So we see, again, this is a 3-year graph from 2019 to 2021. The green part is growing, and the green part is indicates equities, fixed income, corporate, fixed income, sovereign, or basically any AUM over 85%. So any organizations where ESG is incorporated to a greater extent. And we see that. What we see actually over the 3 years is that those that have been doing some ESG integration, which is signaled by the blue and the yellow bands on the graph, that appears to be shrinking. So whoever's doing ESG integration is extending it, covering more and new asset classes. And that is what we actually see with certified products as well. We're seeing a lot more different asset classes covered with under ESG integration. What we see also is this red band, which is around 20 or so percent, remains around 20 or so percent in the last few years. Now, that's really interesting to me. That basically says that there are some investment managers who don't think ESG integration is an approach for them. They decide to pursue others. So, yeah, so it's not that everyone is going to do ESG integration, it seems. It appears that there are some maybe possibly impact investors that choose to go sort of a different route and pick a different approach. Next up is our corporate engagement and shareholder action approach. So we see a 54% increase in 2021, massive increase. On the right-hand side, the graph is just one part of how we measure corporate engagement. This is about reporting activities and outcomes. So we ask, well, actually, this is the whole entire research universe. So we assess and we check for the desktop, and we ask in the survey as well, are you reporting on your activities with corporations, and are you actually reporting on the outcomes of those engagement activities? So we're seeing growth in that response in that regard as well. Over the 3 years, what we're seeing is those that were reporting only on activities are now also reporting on outcomes as well. So that's really encouraging to see. What that looks like in practice are stewardship reports, for instance. A lot of new stewardship reports have been published, inaugural reports in 2021, impact reports and so forth, as well as stewardship being integrated into the policies of responsible investment policies of investment managers. We also ask questions and measure voting practices. So I put in a couple of stats on the left-hand side. 60% vote across all possible holdings, and 14% vote on material issues only. The rest don't vote. You know, sometimes it's not a strategy available for them, or they're just not active in that space. 82% of survey respondents directly engage with invested companies. So we ask about key information sources from our survey respondents. And again, this is another key statistic that supports that actually corporate engagement is really taking off in Australia. The evidence just points to that from a number of fronts. Next is negative screening. Trends. Look, I mean, on the left-hand side, the list is about the main trends there. So the main exclusions are tobacco production, controversial weapons, and so forth. On the right-hand side, the graph aligns that with the consumer searches on RIAA's Responsible Returns website. So here we see, what do people actually look for? What does the public look for here? And look, it's much better aligned than last year. We had a similar figure last year. We see that fossil fuel exclusions are in demand from consumers, but there are also products on offer for that. Animal testing is one area, second from the bottom, where we see consumers seeking products with animal testing exclusion explicitly mentioned, but we don't have a large percentage of assets under management there. Next up, the trends in sustainability themed investments here. And we've got another increase here to 161 billion. The top trends are climate change across the board. Also, we see investments in waste management, circular economy, grow quite substantially. All facets of the natural capital investments have increased as well. So where you see the zeros for sustainable land management last year to 29 billion this year, sustainable water, health, and so forth. They were so minuscule or unmeasurable. I actually grouped them together under natural capital. So all of that last year was 21% of AUM. And now this year I had to split the categories up because there's just such a volume of investment going into natural capital type issues. Norms-based screening is the next slide, and that has dropped. As I mentioned before, norms-based screening is not as popular as in other parts of the world. In Australia, we still see the UN Global Compact as a high coverage conventional cluster munitions. A lot of the UN principles and policies are applied by investment managers as a screen. New norms have emerged, the TCFD, Task Force on Climate-Related Financial Disclosure, and the EU taxonomy regulation. We had introduced just as a bit of a trial category, and we see that rise. Positive screening. Positive screening has also increased 46% to 95 billion. It's not a huge number, but it is a substantial growth. And really, the positive screening is we're getting into the territory of purposeful, sort of impactful investment. So the investments are designed for to make those positive impacts. Top environmental themes, again, climate change, top social themes around sustainable companies, as well as gender diversity and women's empowerment. So that's always great to see. Other social themes are around health and medical, social and community infrastructure, education, income and financial inclusion, sustainable transport and fashion. We have some emerging themes around green property, biodiversity, and reforestation. So again, I'd like to just stress the diversity that's going on in positive screening trends as well. Last but not least is impact investing. We saw a small increase in impact investing to $30 billion compared to 2020, which was 29 billion. You know, the similar trends, green, social, or impact bonds are dominant. We asked a lot more detailed questions so we can better ascertain what is impact investing from our survey respondents and what should be regrouped to sustainability investing. And we see, so we actually asked what sort of goals the impact investments are supporting. So those are the results there: conservation, agriculture, housing, local amenities, a lot of mental health and well-being projects, and with some really good outcomes and measurable goals. The last part of our survey asked survey respondents, investment managers, and asset owners about their attitudes and practices. One of the things that we ask around key drivers and key barriers to responsible investment. This is really interesting in the sense that I highlighted here in red that performance plays onto both sides as a driver and as a barrier. So I thought that was interesting. There is a driver behind improved long-term performance, and the key deterrent was the concern around performance. As part of the barriers, it's also interesting to note the lack of viable product. So building new product, you know, I also read the comments to the survey, and I know that some of the respondents indicated that it's costly and long and just onerous, really, to release new products, and it's difficult. It takes a long time. So, you know, that's obviously something to take into consideration. But the key drivers are demand from above, I guess, underlying investors demanding, as well as the institutional investors demanding. And I also wanted to include the driver to actually make social impact, so the social benefit, where 23% of the respondents indicated that that's one of their top 3 drivers. Great to see. So next up is the introduction of our responsible investment leaders. This is the new logo that leaders that are RIAA members get to display for the year. And with a bit of a drum roll, the next slide introduces or shows you or reveals the leaders. So congratulations to all the leaders for 2022. I know there's been a lot of effort. There's a lot going on in the market for sure. And yes, your responsible investment efforts are not unnoticed. We're definitely watching, measuring, and curious to see how you go. Thank you.
Zsuzsa, thank you very much for that detailed overview of the report. That's great. I want to pass now to Emma Hurd, who's the Partner of Climate Change and Sustainability at EY, and we're really pleased to partner this year with EY on the delivery of this report. So Emma, thanks to you and your team. And I just want to hear from where you sit, sort of your broader kind of reflections and insights that you take away from this really rich data that, an overview of the industry that you see in this year's report. So Emma, I'll hand over to you.
Yeah, thanks very much, Simon. And thanks very much, Zsuzsa, as well for that detailed walkthrough of the actual results of this year's report. I just did want to take a moment just to quickly acknowledge that I'm joining you today from the lands of the Gadigal people of the Eora Nation and pay my respects to elders past, present and emerging, as well as the traditional owners of the lands from which you're joining us today as well. Yeah, we were super pleased to work with RIAA on the report this year. I have to admit, long-time fan of the RIAA Responsible Investment Benchmark Report. It always provides such a wealth of interesting information, trend, year-on-year data, and really interesting insights as to what's actually going on across the investment industry in dealing with both the key issues of our time, but also the fundamentals of responsible investment construction as well. And then there's always that little bit of a dash of the extra external market conditions to throw some spice into the mix as well, whether it's pandemic or climate or key events in the market or company events or energy crisis, or there never seems to be a shortage of external shocks and events which also test the impact and test some of the key developments in the responsible investment world, which RIAA and the benchmark report provides a really useful sort of backing track to the evolution of the market as well. I guess when I went through the report and in terms of the data that came through and thinking around what this meant, I really kind of saw, I guess you could say, three interesting trends that really jumped out at me that were a bit of an amalgamation of the data points and what I thought it might be telling us in terms of how the impact is evolving. So I just want to spend a couple of minutes just to maybe pull together some of those threads in terms of the external factors and that super useful table that's in the report around what's going on and the data and what it sort of says to me, perhaps, is one interpretation in terms of market activity. I mean, the first is very much that growth in integration, that continuing growth in total responsible investment funds under management, up to 1.54 trillion, up again from last year, 1.28 trillion. It's nice to see that chugs up every year. And also as it ticks closer to that tipping over to 50% of being responsibly managed in some form. I don't think we can underestimate the significance of that integration and mainstreaming thematic. I think we tend to look at what sits underneath it without perhaps pausing necessarily to really appreciate just how significant that is, because you're seeing it in the interconnected nature of the approach that investors are taking. So on the one hand, it's a growth in integration. I think it's really reflected in that really significant jump in terms of investors indicating that they're undertaking active engagement and shareholder advocacy. And then also that continued growth of the screening approaches, both negative and positive, is almost like the acting on the outcomes of the engagement or thinking through the implications of the strategy or acting on the actual risk-based information that's applied. And those three kind of areas really seem to me to be talking to the different dimensions of the integration story, and all of them are increasing, which I think is really interesting. It's also kind of interesting to see the increasing tailoring and sophistication of the products being developed, because I think that also is a reflection of the fact that investors are not taking a cookie cutter approach to responsible investment. They're thinking about it in the context of, what is our core investment thesis? Who are we as an investor? What are we trying to achieve? Who are our clients? Who are our members? What is our goal more broadly from an investment perspective? And how does ESG and responsible investment support that strategy and that approach as well? And so I think they're putting some of those stats together really tell an interesting story about the different dimensions of the integration and mainstreaming theme that comes through really strongly. The second theme is really around the impact of disclosure and those regulatory shifts. So disclosure is something, the quest for data, which continues, and particularly I think in the Australian context, just that step up in the last 12 months, 18 months around the regulator focus on both greenwashing, but also in terms of product level disclosure and performance claims is really interesting. And one of the most interesting regulator comments was actually from the ACCC in the last 12 months in my mind. where they made the observation that they thought that greenwashing was particularly important from a consumer perspective because claims of environmental performance potentially provided an unfair competitive advantage if they were not substantiated, which I thought was fascinating. The greener you are, it's a competitive market advantage is a far cry from, say, 10, 15 years ago, where it was seen as a potential drag on financial performance. So that shift, I think, is super interesting and is, I don't know whether it's a glass half full aspect of the greenwashing discussion we're having, but it's definitely a kind of an observation which I think is reflected in the RIAA report as well. Looking ahead, it will be super interesting to see how the emergence of an Australian taxonomy through the work that ASFI is doing influences some of those screening and fund construction approaches. I actually think that's one to watch. In other markets, we see, for example, the EU taxonomy being quite influential in product and fund construction and labelling and disclosure. It'll be interesting to see how over the next few years, both the introduction of the Australian taxonomy and the introduction of an enhanced disclosure regime really support that continued growth in tailored products and funds as well. And we also know that a lot of that is to reflect, as we saw in that slide from Jojo around the drivers, to reflect the increasing demand for greater transparency around objectives and approach and outcomes from different types of stakeholders in the investment value chain, whether it's institutional investors or consumers, wanting to see more info on how funds and investors are actually managing these issues. And which very much leads me to my third comment and observation trend, which is very much this increasing pressure for demonstrable impact. As in, what are we doing all of this for? And what are the issues that we're actually trying to solve? And there's an interesting little bit of a tension here, because for many funds, it is very much solving for the effective mitigation, management, identification of extra financial risk. So the E, the S, and the G risk. But for many consumers and for many stakeholders and for many funds, it's also about having a demonstrable impact on the key issues of our time, like climate change, like human rights, like First Nations rights or social affordability and inclusion. And part of that transparency and disclosure tension is to be more overt around what are you managing for, what's the impact you're trying to achieve, and how do you consistently report on it. And I think it's really interesting, that stat that's in the report on the increase in reporting in shareholder engagement and active engagement activities and outcomes of shareholder action. The two together, I think, is really indicative of that kind of pressure for demonstrable impact. And I also think it's interesting in the context of some of those stats around the increasing approach around waste, circular economy, biodiversity, ticking up in response to the focus of the TNFD and the biodiversity COP that's coming up. So you can see how approach, methodology, data, and those extra issues in the market intersect on the year-on-year stats and the data points in the RIAA report in a super interesting way as well. And ultimately, we know that sustainability is not a journey. Sustainability is actually a destination that we are trying to get to. And we also know that responsible investment is one of the main vehicles that's going to help us get there as well. So the emergence of this report on a year-on-year basis just really helps us to demonstrate how far we've got and how far we have to get in a lot of these issues as well. So I guess I hope you enjoy pouring through the detail as much as we have enjoyed preparing the report. Like I said, for the responsible investment nerds, this is like Christmas comes early when the report comes out. And again, congratulations to the 2022 responsible investment leaders. It is no mean feat to achieve that benchmark, that status. And so I hope you thoroughly enjoyed using your snazzy new logo for the next 12 months in terms of reaping the rewards of that work. Again, really pleased to have partnered with Simon, Juja, Estelle, and the whole RIAA team in terms of delivering this year's report, and really looking forward to hearing more from the panel, just in terms of some of the key stats, figures, and trends, and a little bit of a look ahead as well. And with that, Simon, I'll pass back to you.
Great, Emma. Thank you. Great summary. I really like that sustainability is actually a destination, not a journey. It's a nice sort of point of clarity for us here, and a really good summary of just what we're seeing in this report, I think. So what we want to do with this panel discussion now is bring this a little bit to life, reflections from within the industry as to how this is playing out, and different views drawn from the data to kind of bring it a little bit to life. So I'm really pleased to welcome our panel here. I'm going to just remind people on the call that keep putting your questions in the Q&A function. That's great. I think we've got Zsuzsa busily responding to many of them, but we really welcome those, and we'll have a bit of a chance for me to ask some of the panelists some of those questions as well. We're joined now by a really great cross-section of views and expertise to help us unpack the data. So welcoming here for your Maria Loyes, who's the Chief Customer Officer at Australian Ethical Investment. We've got Erica Hall, who's an ESG analyst at Morningstar. Chris Wiley, Fund Manager at AXA IM, Real Assets team. And Jesse Pettigrew, who's the Head of ESG and Sustainability at BT. So you can see we're going to have a few different perspectives on what the data means and where it sort of is playing out in real time for these market participants. So I'm going to open it up actually just with a sort of starting question to the panelists and say what really stood out to you most and as most interesting about the report's findings this year. And Maria, I might start with you if you wouldn't mind.
Sure. Thanks, Simon. So great to see so much growth, in the market still, and great to see corporate engagement, really growing well. But I've probably got a slightly different perspective to Emma on ESG integration. I was actually quite surprised to see the scale and continued growth of ESG integration. I mean, I think that, the term ESG is kind of being used a bit sort of to some degree interchangeably with responsible investing. And ESG is sort of one approach that's probably getting a little bit kind of muddled up with all of the rest. And, as everybody here would know, it's incorporating ESG information as risk factors to inform stock valuation. And I think that, it's been clear in the RIAA benchmarking reports for several years now that consumers are actually wanting to invest in line with their values. So while many consumers are believing that their money is going towards improving environmental and social solutions whilst also earning returns, a fund using ESG integration actually might include harmful stocks. So I think that is a bit, perhaps it can give consumers a nasty surprise, and I think it is a bit confusing. And whilst there are systemic issues like climate change, the biodiversity crisis, also modern slavery, that can actually impact the stability of the financial markets themselves. I think responsible investors need to be thinking beyond how ESG issues impact the financial performance of a company and thinking about the company's activities in themselves and what's the impact in the real world, and is that impact okay, independent of financial performance. So, great to see that there's corporate engagement there. But I was, a little bit surprised about the ESG integration aspect.
Great, Maria. That's a nice challenge, I think, that distinction between what consumers expect versus what we as an industry see as kind of technical prowess and expertise in the implementation of RI. And I think it goes to Emma's point about the investing responsibly for what outcomes and how we kind of do both, in fact, manage our investments really well and rigorously and managing for risk whilst also delivering for consumers their expectations. And it's something we need to definitely learn and strengthen and substantiate what that means. So Maria, thanks very much. Erica, I wonder if I can pass to you and get your insights on what sort of stood out from this year's findings.
Yeah, I think it's really interesting in relation to performance, because that is certainly important. It's one thing to invest sustainably, but we also want to generate a positive performance while we're investing. And certainly what our data has shown is that the performance is there in the long term. Over 5 years, the majority of sustainable funds have actually outperformed their peers in their respective categories. So I know that we've had some short-term headwinds. We've had inflationary pressures, rising interest rates, market volatility, and performance has been negative, not just for sustainable funds, but sort of generally. And that has had an impact on flows for sure. But I think what's really, really interesting is that in Q2 2022, we saw the broader market outflows of around 9.4 billion. Yet we saw positive inflows of around 875 million into sustainable strategies. So the actual support of sustainable strategies, despite these macroeconomic headwinds, is enduring. And we saw a similar thing that happened during COVID as well. In fact, the broader market was down around 5 billion during sort of the start of the pandemic, yet the sustainable fund flows were still net positive. So to me, that's a really encouraging trend that we're seeing, and I'm really looking forward to seeing if that is persistent in Q3 as well.
Great, nice data. It's the question on it we're getting from everywhere. What's this look like in 2022 calendar year? So thanks, Erica. That's really helpful. Chris, I wonder if I can pass to you for a bit of insights from your perspective.
Yep. Hi, Simon. So I'm coming at this from a real assets perspective, and one of the takeaways from the report for me was thoughts that sustainable investment, responsible investing might mean a compromise in returns. So in the real asset space at the moment, we're really looking at thematics, like where is the world heading to? And this to us means an opening up of not just traditional asset classes, office, retail, industrial, etc., but it means opening up into affordable housing, for argument's sake, because to Emma's point, there's definitely been a market failure in the provision of affordable housing for key workers. So that's a really active space at the moment where we can still drive acceptable returns. Natural capital. So there's a lot of activity in forestry at the moment, and this again is decarbonisation and a transition into low carbon building materials. So this is like structural timber for housing, but we think it will make a bigger impact into the commercial space moving forward. And on that return front as well, there's a lot of activity in rail linked logistics, and this goes to I won't give examples of moving trucks off the road, but this goes to quality of life, air pollution. So there's a lot of activity in rail linked logistics at the moment. So rather than worrying about responsible investment meaning compromising on returns, we actually look at it the other way, and that if you're not looking at these thematics, you're running the risk of stranded asset.
Great, Chris, thank you. Interesting to see how this is merging and being, I guess, more deeply embedded across different asset classes and approaches, which is definitely something that sort of, I think, mirrors that growing sophistication of approach of the industry. So, Jesse, from your perspective, and maybe a bit of a sort of a platform distribution side of things, can you give us a bit of a reflection on what you take out of this report?
Yeah, sure. Look, I guess, what we have, from the platform side is, kind of a microcosm of what you guys see here in the research space. And I guess we kind of have a clear view when we look at the data that we can see on, how that's actually playing out in the real world. I think some of the things that stood out for me, and I was just kind of reflecting on the conversations we've had previously when we've launched this report. One of the things that we kind of started to say a couple of years ago is that we would expect to see more demand for and kind of response from underlying investment managers around reporting, around understanding impact, around exactly what the outcome and the actions of some of these responsible investment processes are. And I think that's what's flowing through in this data now, right? Like we're seeing greater focus on engagement and actually reporting the outcomes of those engagement decisions. And I think that's probably a confluence of things. It's underlying investors, retail investors, advisors wanting that information, but also that managers are becoming more comfortable reporting that, and we're having kind of clearer linkages. And that's definitely, I would say, probably the most common thing that we hear from advisors still, and also to some extent from their clients, is that they're still really struggling. Like they understand the concepts now, which is great. Everyone kind of is clear with what responsible investment is, and that there's different types. But where they're probably still struggling is, how do you know what is a good responsible investment? And even, the next level of that, which is how do you kind of understand and interpret some of these more complex, technical details. We love a good technical acronym in this industry, don't we? Into a way that an underlying investor can understand it. So I think that's definitely probably the next frontier and what we're seeing coming through now.
Can you, Jesse, give us a bit of a reality check, right? Because ESG integration, how well does that resonate with advisors and consumers from your experience?
Yeah, look, I think I don't want to kind of derail this whole presentation into a debate about what is and what isn't responsible investment. But I think, what we kind of hear from advisors is that it's still a really small portion of their book who are asking for this. There is an even smaller portion of that who are really passionate about it. But there is increasingly an expectation, a clear expectation from advisors and from their underlying clients. And I think, that's probably true outside of the advised market too, that this information is being taken into account when people are making investment decisions. And, depending on what your strategy is, or depending on, what you're intending to do, or depending on, how you're choosing or selecting your underlying investments or not, that is going to change. But I think, I think the thing that definitely changed, so we kind of had done this kind of deep research about 4 years ago. The thing that's definitely changed is that there is definitely an expectation and an understanding from advisors that most investment managers should be able to speak about, their consideration of ESG factors, even just to explain that they're discounting them or why they don't think it is. But, won't surprise everybody on this call, but definitely the thing that came through is almost drowning under, sustainability reporting. But, I think it's kind of got to the point now where it's an expectation, at some point, it needs to be considered, definitely.
That's really interesting. And maybe sticking with this theme, I think it's, that ESG integration becoming such a major part of this is such almost a hygiene factor. And there's, in terms of good investment practices, and yet not quite this risk of conflation with what a consumer is thinking about in this space. And I think, Maria, if we can stick on this, I guess there's a risk here with this difference in our understanding of that as an approach aimed towards risk management has been a really strong kind of hygiene factor of good investment practice. And the risk of conflating that with some of the expectations of consumers, this is what, we can't talk about this report this year without talking about greenwashing, right? We've got the regulator talking about this. This is a risky area for us right now. And one I think we're certainly see we need to navigate very consciously and carefully. What's your sort of perspective on this, I guess, and the risk of greenwashing and how that's moving from a consumer, as chief customer officer, what the expectations of the people you're talking to and working for?
Yeah, look, I think the whole industry is really concerned about it. And, we have been for some time, but, in a number of different aspects. So, I think the, risk of greenwash is obviously, going to be biggest where, the product labels and the sales and marketing aren't necessarily consistent with the sustainability claims and the sustainability labels. And so, and they're not, anchored in the reality of how we're actually managing the customer's money. So I think we're going to, the first step, I think, is we're going to need to find a way to kind of bring more rigor into those labels and claims. But I think, it's not easy because I think this example of ESG integration is a great one that, customers don't necessarily understand all of these nuances and differences. And they actually think that responsible investing is pretty simple, I think, in some instances. Just don't invest in fossil fuels, don't invest in companies with human rights breaches. But it's and in many cases it's not actually quite as simple as that. It's a bit more nuanced. And Australian Ethical, for example, people, planet, animals, got animal in background. Australian Ethical invests in companies like, Contact Energy, which is a New Zealand renewables energy provider. In 2024, they'll have a new geothermal facility, which means that 100% of their renewable energy, will come from renewable sources. But in the meantime, when there's kind of peaks and flows in wind and geothermal, they use gas. And so, we do, in part of our framework, we do have the ability to still invest in that because we think it's the right thing to do. But it means that we do have some fossil fuel exposure there. I think, our customers, think that's the right thing to do as well. But we have to be really clear that we are being really transparent about that. And we on our website we have a lot of information about how we approach particular issues, particular sectors, but it's not always easy because sometimes when you share a lot of that information, customers can actually become quite suspicious. So when they hear about exceptions or they hear about thresholds or provisos, they're kind of like, oh well, is that genuine? So I think we're going to need to try and build customer trust in this area. And we're going to need to build a kind of an understanding of the complexity of responsible investing and, kind of make that case to them that we're genuinely working on positive solutions to the things that they care about.
That's great, Maria. Thank you. That's, I think that's so important right now, is that precision and clarity in how we're using terms and terminology, and the ability to substantiate what we're doing and what that responsible investment approach means to us as an investment manager is critical now more than ever. And I think in that context, the way we define responsible investment leaders in this is very clear and precise in terms of that is explicitly and systematically considering ESG factors in allocation of capital and being transparent, reporting publicly, not just on activities, but on outcomes as well. And that sort of is a point of difference from certified products or responsible investment products. And I think that sort of distinction becomes increasingly important for the market as well. And so I think you'll hear us talking a little bit more about that distinction, about organisation-wide commitment, processes, practices versus the product level sort of embodiment of that in a clearly labelled and defined product. I just take in that a little bit further. One of the trends that we've seen is this increased sort of elevation focus around climate change management, risk management, and investment in opportunities and avoiding risks. And I guess, Chris, interested from where you sit from a real assets perspective, some of these complexities around that actually often play into this greenwash area if we talk about them incorrectly or imprecisely around decarbonisation, net zero. There's been a huge growth in that area. What are your sort of observations as that emerges as a bigger part of what some investment managers are managing for and consumers are looking for?
It's such a fast-moving area at the moment, Simon. So the first thing to Maria's point is we in 2021 have set out some very specific short, medium, and long-term targets, and they are they're split into decarbonisation, climate resilience, and a social pillar as well, and they're very specific pass-fail. So there'll be what we explain in there what net zero means. Is it scope 1, scope 2, scope 3? If you can use offsets, what type of offsets can you use? In what circumstances can't you use offsets? So we've basically tried to publish our own rule book that's transparent and open, and clients, external clients or internal capital can decide whether they're happy with those targets and metrics that we've set for ourselves. But I think one area that's really risky on greenwashing is there was a flurry of we're net zero last year. That's great. Let's go to lunch. We're looking at it slightly differently at the moment, in that we're really talking about decarbonisation. And let's pick office buildings for argument's sake. An office building isn't a dumb asset. It doesn't just turn on at 6 o'clock in the morning and turn off at 6 o'clock at night. So we're starting to introduce decarbonisation terminology into discussions whereby, with 5-minute interval data of the grid as to how green the grid is, on a January 11 o'clock morning in Sydney, when the Sydney grid gets up to 16, 18, 20% renewable resources, why don't we work the buildings harder and get them to react to the green element in the grid? Maybe get the set point temperature in the building down to 20 degrees for argument's sake. And as wind and as solar dies off at 2, 3 o'clock in the afternoon, why don't we turn the air conditioning off and just let the building drift up in its temperature? So we're starting to play with buildings now in this decarbonisation space to match demand to green supply in the grid. You asked about greenwashing. That enables us then to engage with our stakeholders as to what we're doing to actually decarbonise the grid, and not just run out and buy offsets if we haven't solved some underlying issues at asset level.
Great, Chris, thank you. Hey, Erica, I wanted to bring you in again, this area of corporate engagement. You know, this is some really positive developments and points of evidence, I guess, in this report, showing that what has long been something that's quite kind of an area in responsible investment, quite amorphous or a little bit opaque, hard to pin down, what does it actually mean? We're starting to see this changing, and I think engagement or stewardship practices really becoming a really strengthened and prioritized tool in the toolkit of responsible investors. I'm curious as to how that's playing out from your perspective, and just what sort of the shifts you're seeing in that area play out in real time in the marketplace.
I mean, the obvious one is AGL and the shareholder activism there that led to the stymieing of the demerger activities that were proposed. So absolutely shareholder driven. Mike Cannon-Brookes, a billionaire in a unique position to be able to buy a reasonable stake in the company and then collaborate and share his intentions and his concerns with other stakeholders to actually enact change. And as a result of that, they now have more, I think there's 3 members of the board that are more renewable energy focused. They obviously had the MD resign, the chairman of the board resign as well, and they have a much more robust approach to decarbonisation and a plan in place that they didn't have before. So I think that what we are definitely seeing is increasing activity in merger and acquisitions relating to ESG thematics. And, you know, I think these companies are sort of looking at their ESG goals and objectives, and if the assets they are holding are not compatible with that, they are looking to offload them. And so we've seen that with Woolworths as well. Their liquor, gambling and hotel assets, they did a demerger. They set up a separate company called Endeavour. And as a result of that, a number of asset managers have told us they can now invest in Woolworths, whereas perhaps they couldn't before because it didn't meet their sustainability objectives. We've seen the same with BHP and Woodside. They've sold off their petroleum assets to Woodside. Some asset managers can now invest in BHP and are doing so. And obviously BHP is, you know, is a substantial company. It's the largest market cap company in our stock market. So not holding that asset is really challenging for a sustainable investor. It creates a whole raft of other challenges. So it is encouraging that these larger cap stocks are, I guess, cleaning up their asset books and allowing the asset managers to then invest into them. However, BHP doesn't work for everyone because they're still holding some of their coal assets. So the Mount Arthur coal assets remain. And so again, it comes down to individual asset managers' objectives and you know, what they will and won't be able to invest into.
Thank you. That's great. And I think we're getting the report tends to be telling us a little bit more clearly on not just the activities in corporate engagement. We kind of went from having corporate engagement with no disclosure at all to corporate engagement with a little bit of disclosure on the activities. We voted shares, we had lots of meetings. Now we're getting into activities and outcomes. What have we achieved? What are we aiming to achieve? How are we progressing and even escalating? I think we're seeing that trajectory playing out in real time. I'm interested, Maria, from where you sit, what's that looking like in terms of effective corporate engagement from an Australian ethical perspective?
Yeah, so I mean, you know, for a long time, our ethics team have been engaging for, you know, real world impact, guided by the Charter and its 3 pillars, which are people, planet, animals. Hopefully the animals will stay quiet. So, you know, that means that, you know, we tend to focus on those systemic risks like climate change, and we look for ways to kind of leverage our investor position to influence on those issues. Irrespective actually of our portfolio holdings, we will engage outside those too. So, you know, I think, and we've been reporting on the outcomes of those engagements for a long time. But I think, you know, the UNPRI, their latest kind of active ownership framework, has made it clear that it's not enough just to engage with companies about their, you know, financial risk and return. We need to be thinking about the systemic issues and whether the real world impact is sustainable. And so, you know, it sets the expectation that investors focus their stewardship activities on outcomes. And so for us, what's developed or evolved is, you know, the ethical research team are kind of focusing much more strategically, proactively, and have a longer term approach. And so, you know, what do I mean by that? I think previously, you know, we had quarterly reporting, which showed a sort of series of engagements. What were the outcomes of those engagements? But, you know, probably slightly random in terms of a list of engagements that didn't necessarily talk to each other and didn't necessarily think about progress over a much longer period of time. So now we're focusing the ethical stewardship on strategic initiatives. So we set out what the real world outcomes are that we're trying to achieve, and then work backwards to go, what are the things that we need to do to actually deliver on that? So, you know, we've got 4 key areas, and there will be some engagements outside of those, but the 4 key areas, and so one of them is we obviously don't want to see an unsustainable expansion of fossil fuels in Australia. We won't invest in fossil fuel companies, but we use our influence with the finance sector, so banks, insurance companies, to make sure that the lending and underwriting and investment that they have in fossil fuel companies is in line with Paris agreements, and we kind of interrogate their criteria for that. So we've been doing that for close to 10 years, but rather than, you know, reporting on each of those as a standalone example, we're now, developing that strategy, kind of thinking ahead, if you like. And recognizing also that it can take a lot of time. Real world change takes time, but it also takes a collaborative effort. So we're also focusing on, what groundwork can we do to identify NGOs and other organizations that we can work with, and others in the responsible investment community. So how can we join together? So, as well as, turning off finance for unsustainable expansion of fossil fuels, we also have initiatives focused on livestock driven deforestation in Australia, because that's the prime cause of deforestation, and we have some really not very good track record of that in Australia. Alternatives to animal research, and then the final one is reducing building sector emissions.
Great, and I think that's a really good example of that sort of systematic nature that our leaders, we're seeing more and more of our responsible investment leaders putting in place behind corporate engagement, a really clear targeted areas to impact upon, and a really clear plan, and then sometimes that escalation process clearly articulated as well. Probably worth flagging, late this year in November, we're currently doing a research piece on the state of stewardship in the market, and so we'll be launching a standalone stewardship benchmark report in early November, which will give a bit of a sense of the market activities underway and what leading practice is looking like. So there'll be research underway currently that Zsuzsa is leading as well. Before we go to Q&As, and I see Zsuzsa's been answering busily the questions coming through, so thank you. But we'll go to that in a minute. I just wanted to go back to Jessie and say, from a financial advisor perspective and that clients through advisors, can you give us something of the sense of the different sort of expectations of, across demographics and ages and things that you're seeing currently?
My favorite topic. It's almost like we prepared this beforehand. Thanks, Simon. Look, I think the thing that has stood out for me from the most recent conversations, and I would really say in the past, kind of post-COVID, in the past kind of 12 to 6 to 12 months, and I think, that the kind of diverse versus engaged conversation that we've just had here as well is really kind of part of that. I think just the ability for advisors and for their clients to have a better understanding of some of these impacts is really increased. So, some of the standard demographics that we've always seen haven't really changed. So definitely older clients are more interested in what they're not invested in. They tend to be more ethical, values-led. Advisor groups that had a younger client base or focused on younger clients tend to be much more interested in sustainable themed investments, thematic investing. They tend to be a little bit, I wouldn't say less concerned about what they're invested in, but they really have understood, and to some extent, I think that the AGL conversation and that playing out in the media, and also the discussion, with BHP selling to Woodside, and you're not actually necessarily seeing those assets disappear, you're just seeing them move. I think that has really, people who are engaging with that discussion have really kind of started to understand that, there are differences and there are nuances in that debate, and it is about your own personal values. So that has kind of, I think, advisors are saying they're having that conversation more with their younger clients, and their younger clients are kind of more interested in what's available, how can they kind of see their money doing good, where are their impact investments or other things that they might be interested in. The other thing I would really say that stood out for me, and I think is really interesting, is that it's not, there is a small portion of the market, and there always will be a small portion of the market, and it will probably grow, that wants their whole portfolio invested ethically or, invested sustainably, and they have their own definition of what that means. But increasingly, it's not a whole portfolio, it's not a whole kind of, piece. It's having one or two, different types of responsible investments in the market. People are getting in the portfolio. Both advisors and their clients are getting more comfortable with just testing the waters, seeing what happens, seeing how different things respond. I think research like this really has helped that. Like, it's really given advisors more confidence that, responsible investments do perform, that there are different, ways that their clients can be invested responsibly, and kind of finding the right allocation in their portfolio. So they would be the kind of things. The other thing I would say that really stood out as well was that advisors, while I will repeat again, it is still a small portion of their book, they are very clear that it will change and it will continue to increase, and so they're really leaning into this space now. Absolutely.
Great, Jessie, that's really helpful to understand. So a few questions coming through, some have been answered live. One here about this commentary around natural capital risk and what actions are Australian investors taking or looking into. And I know, Maria, I think you've just talked to a few examples of that in terms of deforestation, for example. Chris, I wonder from a real assets perspective, you mentioned this a little bit, but can you flesh that out a little bit more, the types of actions we're starting to see from investors taking around natural capital risk?
Hi, Simon. Yes. Natural capital for us is so we're real assets and an alternatives business. So the forestry space that we're involved in at the moment has been typically focused on sustainable harvesting of structural timber. But there's lots of infill pockets around this forestry estate. It's about 25,000 hectares of forestry space. So natural capital that we're looking to improve the biodiversity management of non-productive areas of the forestry. So that might be an acquisition of wetlands that are next door to the forestry investment. So it's not necessarily capable of structural timber growth, but it fits into AXA IM's longer-term biodiversity plan for this additionality next to existing assets that we have. So what does that mean? It means it's a small area of wetlands next to the forestry investments. At the minute, we'll just open up the taps. We'll allow that to be flooded for wetlands again, and that will feed into our natural capital asset base. So there's not necessarily a live return from it at the moment. It doesn't fit into like a carbon offsetting plan where we'll look at deriving credits from that space, but it just forms part of an overall natural capital strategy that we have.
Great, Chris. Nice example. Thank you. Hey, Emma, I wanted to ask you a question. The focus by the regulators on greenwashing, and lots of the questions are coming around greenwashing, as they inevitably will, and so many different approaches to divest or to engage or to how you label a product or ESG integration. But I'm wondering, what's the impact, or are you seeing any impact on the market of this growing focus by ASIC? And we saw the ASIC information sheet come out in July, which was really quite clear in their expectations. How do you see that play out in the market?
Yeah, I think it's probably got a couple of, a few different impacts, to be honest. I mean, the first is that it's probably a really useful reminder for many corporates and companies that are increasingly making claims around their broader sustainability and environmental performance, around the robustness of those claims and being completely transparent around what the component parts are of that strategy. Probably this is something that investors will be very happy to hear, because I think that a lot of active engagement has been on the basis of, what do you mean when you say? And I think there's been a little bit of frustration in the part of a lot of investors in terms of trying to decode or translate corporate claims. So I think getting some greater granularity and robustness around corporate claims on environmental and sustainability performance is one part of it. I think the second part of it is also, though, being really clear around the component parts of fund, portfolio, or product level disclosures as well. So a lot of the discussion that we've had already today in terms of, are you managing for pure financial risk mitigation of ESG factors, in which case you may still have exposures to a lot of stocks which are still considered to be not necessarily aligned with what consumers might be believing, or are you actually investing to have impact through a corporate engagement activity, so therefore you're remaining in the stock to a point, and how transparently do you communicate that, or are you actually investing for a more sort of dedicated negative or positive screening or impact-based approach. So I think on all fronts, it's that focus on, what do you mean when you say, because we haven't had the consistency and standardization of terminology to allow you to just use it for shorthand, right? So it's sustainably aligned fund. That could mean like a dozen different things. My concern, though, and it's great to see so much focus on the robustness of claims, my concern, though, is that we don't let regulation and compliance act as a handbrake on innovation and ambition. And I say that from the perspective of, if it tips too far in terms of granular specificity on language and acts as a limitation or a constraint on the ability of both companies and investors to be a bit more forward-looking or aspirational in their ambitions around performance movements, then I think that becomes a little bit counterproductive. And so I think we just need to get that balance right in terms of addressing these issues from the perspective of greater transparency, greater standardization, greater market access information, greater robustness, without actually losing that accelerating action and ambition, which has been the hallmark of this industry and activity in this space for so long. So work to do, I think, in the year ahead.
Yeah, great. Maybe a follow-up one for you, Emma. Just there's an interesting question about flipping it from the other side. If you're a company wanting to attract and approach responsible investors, you know, what's the world look like from a company side now, and how do they sort of make sure that I guess responding to the shift we're seeing in this data, that huge growth, etc.
Yeah, I mean, I think we're seeing all sorts of super interesting permutations on this front, right? So, I mean, probably the most well-known one is like company reporting and increased integration of I hate the term, but non-financial information in financial reporting, or extra financial information or ESG information into financial reporting. You're seeing that squirreling in much more firmly into the financial statements and accounts, and that is only going to continue more with the emergence of the ISSB. You're also kind of seeing it coming through in standalone dedicated reporting specifically to the investor community. So climate transition action plans is a good one, for example, which, God help us, now has an acronym, a CTAP. You know, it's so we've already acromanized it. So we're definitely seeing it emerge as a standard sustainable finance tool. And there's a whole debate around what should be included in that versus in the financial reports. You're also seeing, interestingly enough now, ESG prospectuses, which is specifically for the purposes of capital raising in the market. And this can be either for debt or equity, because a lot of companies are targeting both investors and banks in terms of their sustainable finance or opportunities and credentials. So you're beginning to see, we're raising capital. Here's how, as part of our core value proposition, we also help you achieve your ESG goals and your responsible investment goals as well. So you're kind of seeing this kind of interesting differentiation in communication types and channels. And then, of course, there's the value chain discussion in managers reporting to asset owners, super funds reporting to their members, everybody reporting to the regulator. You're kind of seeing these information flows, all kind of the channels kind of emerging and different needs for different types of information to more or less sophisticated investors. Like there's a whole other discussion around integration and disclosure, which is very much around who are you reporting to and what information and why and how do they use it, which is also a whole other aspect of the company to capital market conversation.
Brilliant. Thank you. That's a really great discussion from the panel. We're getting close to wrapping this up. So, thank you for all of those questions coming through. And Zsuzsa, I think, has been answering numerous questions. So thanks, keep them flowing through. But I do want to sort of end this panel by asking people really briefly of, you know, we've seen all this change, this momentum, this rapid shift and evolution in this sector. So what does your future prediction look like for the year ahead? And Maria, maybe I'll start with you, and I'm looking for a minute each here as we get close to the end of our time, please.
What's it going to look like for the year ahead? I think, I think we're going to have to make sure that we've really got alignment with what we say and what we do. And so I think, you know, for investors that are wanting to move into becoming a responsible investing leader, I think that's going to be about being authentic, being transparent, measuring meaningfully, and then probably not cherry picking. So pick one or two sustainability things and make sure that you're kind of doing it properly.
Yeah, brilliant. Thank you. Chris, can I go to you next for a prediction?
Yes, Simon. It will be the harmonisation of terminology. You talk about net zero, what do you mean? You talk about climate resilience, what do you mean? It will be the use of things like CREM tools, for argument's sake, to identify stranded asset risk. And for a company that covers different borders, that common terminology is key.
Brilliant. Thanks, Jessie. Chris, harmonization of terminology, my dream. Look, I think those two, though, to that point and to the point Maria made, I think one thing, maybe not in the next kind of 12 months, but I think kind of the thing that is definitely coming is, you know, retail investors or end investors, be they members of super funds, be they people going into their financial advisor, be they people, you know, buying ETFs on a small micro investing platform, are going to be clearer about what they think, you know, ESG and sustainable means, what they want out of a fund when it says sustainable investing, and then, you know, both the things that Chris and Maria spoke to are going to enable them to find the funds that suits them. So, you know, I do think we're getting to a point, you know, hopefully relatively soon, where the investors are actually better connected with the sustainability stories that investment managers are telling, and you know, they're connecting with what they think that they are, and happier with where their money's going.
Brilliant, Jessie. Thank you. Erica, can I get your thoughts on the next year ahead?
Yeah, I think continued focus on climate and reducing greenhouse gas emissions for sure. We've seen that globally investors are favouring strategies that support climate solutions. We look at it each year, and you know, in 2021 calendar year ending, we saw assets in climate funds doubling. So this is a big thematic, and you know, it's also, we're seeing that play out in the Australian market as well. Local investors are committed when it comes to investing in climate solutions. We categorise the world into Europe, China, US, and then the rest of the world. And Australia leads the way in the rest of the world in terms of money invested in climate solutions. And then I think as an adjunct to that, we're going to see more focus on responsible management of water along the lines of what we've seen for decarbonisation. So I think we're going to see more interest in investing in this way, and more lobbying from investors to sort of make sure you know, that this is, you know, a topic that we're taking seriously and considering.
Brilliant, Erica. Thank you. Emma, I'd love your thoughts on the prediction for the year ahead.
I think all of the above. Definitely endorse everything that everybody said. I'm gonna sneak in two, if I can, Simon, somewhat cheekily.
Go for it.
I think the first is that biodiversity is actually coming at us like a freight train as an industry. It's got all of the complexity, some of the terminology, and a lot less of the data than climate. But I just see that really evolving incredibly quickly, and investors are really now really pushing to get their heads around what is that going to mean across their holdings, their portfolio, and all companies. And the biodiversity COP at the end of the year will be a big factor in that. But the other one is probably more of an Australian specific one, which is that we've had a long period of time where the industry has been developing its ESG and responsible investment approaches mostly separate from regulatory and policy discussions. It's been industry driven. And I think we're going to see in the current year a lot more re-engagement with policy and government around both the thematics, but also the regulatory structures and underpinnings of that support responsible investment. So that's disclosure, you know, climate legislation, but also what is the role of government facilitating the growth of responsible investment. So I think re-engaging with policy in a way that we haven't had necessarily done for the last few years in a constructive way, dare I say, is probably, I think, going to be a bit of a theme of the year ahead as well.
Yeah, great. Thanks, Emma. Zsuzsa, I'd love your insights too. You've spent a couple of years very, very deep in this data. Where do you think this will be going for the year ahead?
Good question. I'm so into the past, not so much into the future. Look, I think I really like to see the theme on diversification. I'd also like to, I'm not too hung up on the taxonomy. I think belief that that's going to solve everything is it's just not going to. It's going to probably you know, raise more questions than before, but I would really like to encourage stakeholders in the market to be on the lookout of new products, and making sure that those products are actually aligned to those aims or targets. So one of the things that I didn't see a lot of evidence on, there's a lot of monitoring and going on, especially carbon emission, portfolio, et cetera, intensity, blah, blah, blah. So monitoring is going on. I want to see more targets. So can I challenge everyone to set targets for their investments, whether they're social, climate change, or environmental?
Brilliant. Thank you. Nice challenge call out there at the end. Thank you to our panelists. We just covered a whole lot of turf, and to all those still with us, this is really, you know, it's a lot to unpack here. And I think we've heard a lot about this fascinating moment in time that we are up to right now in this industry's evolution, the 22 years or whatever. But I think also it's right to call this out as a fragile moment, and one that we need to be really intentional as to the next steps of the industry to build that credibility, to build on that, to converge around some of those standards, to strengthen and hardwire in those standards, really to be delivering what our consumers and clients are looking for, which is that demonstrable impact of what are we actually achieving through these processes. So it's a really fascinating time. Now, Craig, you've been sitting patiently in the wings through this, and welcome. Craig's the head of institutional at T. Rowe Price. I'd really welcome your kind of wrapping up reflections on what you see in the report, but what you've heard today to kind of close out today's session. So Craig, over to you. Thanks.
Thank you, Simon. Thank you, others, and congratulations, RIAA, on clearly an exceptional report, but also what a valuable panel discussion. Simon, I thought it might be helpful if I just reflect on the journey that we've all come from maybe 10 years ago and kind of look out to the future, because investing is a long-term game. And as somebody who, 10, 15 years ago, there were a few of us maybe trying to convince people that ESG was worthwhile, using corporate marketing budgets to attend events and then phoning our friends to try and get people to attend, trying to get behind RIAA in the early days. What a delight, utter delight to see the richness of the discussion, to see how extensive it is. I read a quote this morning from Gary Weaven that I thought was actually quite relevant, though, because investing is a long-term game, and ultimately we manage money in trust on behalf of others, and good organizations understand their social license to operate. So forgive me while I just read a quote, which I think is probably quite good for all of us to reflect on as we look into the future. So Gary was talking about the really big funds. He says, I think it is a challenge for the big funds not to lose their sense of purpose. And he writes, back in the 80s, when superannuation was started, the industry was run by mutual life companies. Not one of those companies out of a total monopoly are alive today. And that's because they lost their purpose, they lost their way, and they disappeared. The same can happen to the great funds of today if they don't continually renew themselves, innovate, and understand their social license to operate. So I think what I observe in the ESG trend is in the last 10 years, we've moved from a few people saying, look, this is really important, to what an incredibly robust discussion today over quite an extensive thing. And Bryony, that timing could not have been better. And I think this chart for me is really helpful because there is no one solution that you have to apply yourself to. But both as a fiduciary and on a social license to operate, I think it's important that each of us, both individually and as an organization, look at this and ask ourselves, where should our organization get involved so that we might look at ourselves 10, 15, 20 years time, and for a short period of time, while we're all lucky enough to sit in these seats overseeing fellow Australians' money, that we made sensible, long-term, wise decisions. There is no one size fits all, but there's certainly an opportunity, if there is a will, to get engaged in the process and to make wise, long-term, investment-related decisions that will benefit. So that's, I suppose, the big call out. There's a social license to operate. It's given to us for a period of time. Let's use that time wisely. I just want to pick up on a few comments and then a quick wrap. I'm conscious of time. But the things that really stood out for me in terms of this discussion today, Simon, Maria, your comment about is the impact we're having actually okay? Simon talking about investing, well, for what outcomes? I think that was a good question. Erica, the amount of money that's kind of flowing out in markets, and yet the stickiness, as you called it, in terms of sustainable, I think that's both great, and yet it makes me nervous because if we're doing this just for short-term profit motive, there's a problem. But I think it does speak to the sustainability, longer-term sustainability of a client's capital if it's managed wisely. And I think that profit motive is important. Chris, I thought your comments around stranded assets and using buildings, fantastic story. Thank you so much for sharing that sort of innovative thinking. Jesse, you then talked about the demand for reporting, and I think that's really clear, right? That speaks to the credibility of the processes that we're doing. That it's one thing to do stuff and keep people's money and try and make money, but it's really important to report on what's actually happening. And then Maria, I loved your quote, genuinely working on RI solutions that people can care about. So I suppose as a look ahead, right? If 10 years ago, there were a few of us, today we've got an incredibly robust discussion. We have this very helpful framework from RIAA. The question in my mind is, what is the discussion, this type of discussion in 10 years' time? And my sense is that we're going to see growth in impact, and we're going to see growth in sustainability themed investing, and that ESG integration phase of trying to convince people that that is really interesting and is worthwhile is good. I think the caution I worry about, Simon, is now that so many people are integrating ESG risks, what happens when the next problems occur? Are we alert to the problems that occur? Because when nobody was supposedly considering the risks, we could point fingers. So that's the bit that I think we just need to be careful about. Ultimately, we're an investment industry called to make money for our investors. Great privilege to be involved. Thank you for a fantastic report, Simon, and to Susan and others.
Craig, thank you. And thanks to our panelists, Erica and Jessie and Maria and Chris and Zsuzsa and Emma. Thanks so much for your contribution. That really sort of brought this report to life, which is what we hope to do there. You know, we are at a critical moment in the juncture, I guess, of this industry's evolution, and RIAA sees it as really important that we continue to work on the credibility, on the standards, on the clarity. And so we're advocating for policy, building in verification, doing the research that underpins it, and convening the collaboration that's required to kind of drive the kinds of impacts and outcomes we're after. So really pleased to again bring this report to life. A huge thanks to our sponsors who help us bring this huge bit of research out to the market for 21 years now. That's to Australian Ethical, to AXA Investment Managers, to BT, to T. Rowe Price. And of course, a huge pleasure working with our research partner, EY, Emma, your team, and of course, Morningstar with the support for the data provision there. I always want to say a huge thanks to those who respond to this survey. It's a huge survey. We all have survey fatigue. We're well aware of that, and we're working to consolidate these surveys and make it easier. But that data is integral to us being able to build that picture of what the state of this industry. So thank you to all of yours. And to all of those who have joined us this morning, huge thanks for coming along. We hope you got a lot out of it. And we look forward to working with all of you over the year ahead to continue to build this industry and everything that underpins such a strong and successful responsible investment industry. So with that, I'm going to conclude proceedings. Thanks for joining us and have a good Monday. Thank you, everybody.